This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and look at the second share-based payment that we have, which is looking at your cash settled. So in the previous session, we went through and looked at equity settled. So I hope you're all comfortable with the theory behind that. Cash settled, very, very similar. But remember when we spoke about things in the introduction, that there's two aspects that are different. Remember, first of all, when you look at the fair value of the share option, you go through, don't you, and take the fair value of that option at each reporting date. Okay, so unlike your equity settled, whereby you took the fair value at the grant date, here you take the fair value of the share option at each reporting date. Again, we still go through and take it to profit or loss, so no different there. We still take it over the vesting period. We still take it based upon the number that we expect to exercise. However, the second difference, remember, is that on the statement of financial position, you don't recognise equity, you recognise a liability, don't you? As we are creating that obligation, because we are going to pay cash to the employees based on the performance of the share. Sound familiar? Exactly what we spoke about on the introduction. Brilliant. Let's go through, shall we, and have a look at the example. It's the example there. Just underneath, it says that I prepare the extracts to be shown in, again, profit or loss, your position statement for each of the 3 years, December 15 to December 17. So it says there, Gouda granted 10,000 cash settled share-based payments to its 20 directors on the 1st of January 2015, and they vest December 2017, so 15, 16, 17, 3 years. It's anticipated again that none of the directors will leave over the 3-year period, and the fair value of the option is as follows. So you've got the $12 there at the grant date. We can ignore that, can't we? Because we want to take the fair value at each reporting date. So we have it there, is it $13.50 at the first reporting date, $13.80 at the second, and $14.20 at the third. So let's use those numbers, substitute them in, see how we get on. So when you're looking at the statement of financial position, remember that's one of the first key differences, isn't it? Is that you record the liability. So we have a liability for 2015, for 2016, and for 2017. On the statement of profit or loss, we have an expense, don't we? And that expense, remember, is the movement, isn't it, within the liability. Okay, all sound familiar? I hope it does. You then go through and take the working, don't we? So within our working, what have we got? So let's look at the first year end, is that 2015. In 2015 we had, was it 10,000 options? We had 20 employees. The fair value of the share option or the share-based payment is there at $13.50 at the end of year 1. And we are at the end of the first year of a 3-year motivational scheme, aren't we? Tap that into your calculator. I think you end up, is it with $900,000. So 900,000, that is what we show as the liability, isn't it? And the expense is exactly the same figure in the first year, as you recognise a liability that starts at 0 and goes up to, is it the 900,000? First year is normally one of the more straightforward. Second year, it gets a little bit more difficult, doesn't it? So we have the same 10,000 options. Again, we're keeping it simple by not changing the employees, but we are changing the fair value of the share-based payment scheme. It's now $13.80 at the end of the second year of the 3. So here is it 1840,000 if you tap that into your calculator. I think you're now about to know what we say for the next bit. In fact, you could probably talk your way through it as I write the numbers down. Yeah, did you talk your way through it? I hope so. Yeah, so what you've got is at the end of the year, you've got the liability of 1.84 million, haven't we? Remember, it's the movement that goes to profit or loss, and the movement there is the 940,000, isn't it? There we go. If you want, you can have a go at the third year by yourself. So pause the video, good idea. And then once you've done it, restart the video. Okay, so have a go yourself, pause the video, work it through, and then come back and join me for the end. See you in a second. Did you stop the video? I hope you did, because if I give you a chance to have a practice at things, it's definitely worthwhile taking me up on the offer. So well done if you did. If you didn't, shame on you. So you've got the 10,000 options, the same 20 employees. Here the fair value of the share-based payment is $14.20, isn't it? And as you're at the end of the third year, you don't need to, but you can multiply by 3/3. Does that give you, is it 2840,000? So that is the liability, the obligation at the end of the third year. Yep, right, the movement. Even I can do that movement without any serious thought process. That movement is there as 1 million, isn't it? Okay, there we go. Everybody happy with that example? Hope so. Again, the key bit there is that we have changed the fair value of the share-based payment at each reporting date, but we haven't as of yet made any adjustments, have we, to the changes in the expectation of the number of employees. Okay, which I suppose you can guess is what we see, isn't it, within the next question. So immediately after that first question there, based on the fair value of your cash settled, we have there a little bit to look at. Oh, it's gone too far. Apologies. To go through and look at a similar scenario based on cash settled share-based payments, but whereby we make adjustments for the options that we expect to be exercised. So again, it goes through there and looks, is it at profit or loss? It also goes through and looks at your position. Here it just wants 2 years, December 14, December 15. Okay. On the 1st of January 2014, so at the start of the first financial year, Cheddar granted 20,000 share appreciation rights. So remember, you have to be happy with the terminology. Share appreciation right, doesn't it? Is the same as cash settled. Okay. It says there that we had 10 directors, so 10 employees. They must remain as an employee for 3 years. And then here you're given the fair value of each cash settled share-based payment at December 14 it was 80. December 15 it had fallen to, is it 75? We're then given the bits about the expectation. So first year it was as 4 directors, wasn't it? Whereby in the second year, at the end of the second year, we estimate that 2 directors will leave over that 3-year period. So what we've got is, let's go through and have a play around with it. Again, it wanted extracts, didn't it? So on the extracts for the SFP, you're looking at a liability, and that was for 2 years, 2014 and is it 2015? We shall do a working for that. And then on the statement of profit or loss, you're looking at your expense, and your expense, remember, is the movement in the liability, isn't it? Again, that will come from whatever we do within the working. So if we have a look at the workings, is it there for 2014? It becomes a bit repetitive, doesn't it? We have 20 options. The employees, we started with 10, and we expect 4 to leave over the period. At the first reporting date, the fair value of the share-based payment was $80, and we are at the end of the first year out of 3, aren't we? So multiply by 1/3. Divide that there by the 3, as we said, and we'll multiply by 1/3. Gives you 3.2 million. Okay, and the issue that we've got there is we've dealt with the change in employees and the fair value at the reporting date. So 3.2 million is the figure that we have as my liability, and the expense is the movement, which is the same, isn't it? Because we started the year at 0. Okay, so we've gone from 0 to the 3.2 million. Do you wish to have a go at 2015 yourself? See how you get on? If you do, then great, stop the video and then restart it once you've worked it through. If not, let's go through and carry on, but I'll just give you a moment if you do want to work it, just to pause it before we then restart again. So welcome back for those of you who have gone through and worked it yourself. Hopefully you got the correct numbers. You've got 20,000 options. Here we expected, was it 2 employees to have left? So that's the key first bit that you need to adjust for, isn't it? Secondly, as well, was the fair value at the reporting date. So hopefully you've changed that to, was it 75? And then the bit that may catch people out is, don't forget, we are at the end of the second year of the 3. So multiply by 2/3. Did you get a figure, was it of 8 million? Yeah, a couple of nods around the audience. Excellent, well done. So you've got 8 million that goes there as your liability, doesn't it? And the movement is that 4.8 million. Okay, perfect. Hey, if you want the journal entries, let's just go through and put them in. I'm not too worried about 2014. At 2014, the first year of a scheme is pretty dull, isn't it? Okay. In 2015, what you've got there is you debit your statement of profit or loss. You credit your liability with the movement, wasn't it? So is that there with the 4.8 million? The reason why it was the 4.8 million is because we were looking at the movement. and the movement was taking it up to the 8 million from the 3.2 million. Okay, there you go. That covers all the basics, all the fundamentals that you need to know about your cash settled share-based payments. You also know the basics and fundamentals about equity settled share-based payments, so you shouldn't come unstuck within any exam type of question. So let's go through and look at an exam standard question that you could expect within your F2 paper. I think exam standard questions are going to be very similar to what you have here. Obviously, we'll see in a moment, it asks you to record the journal entry for a share-based payment scheme. We won't give it away, whether it's equity settled or cash settled. But as well as thinking about the journal entry, it might ask you what the expense is for a particular year. It might ask you what the other component of equity figure is, or what the liability figure is to appear within the financial statements at a particular year end. So there's a good scope of the style of question that you could be asked for, but I think if you understand the basics and the essentials that we've covered, you aren't going to go too far wrong. So I would be looking for this type of question within the exam if you can, because I think it's perfectly passable. So what you've got there, as you can see at the bottom, it's got some options that you need to put to complete the journal entry. So there's some numbers with the journal entry, and then there's the account reference as well, isn't there? So where do you process the debit, where do you process the credit? Okay, so what you have as a company is they're called RT that granted 1,000 share options. So remember, when you're looking there at share options, that's also referred to, isn't it, as your equity settled. So you know the rules about equity settled. You take the fair value when? Can't hear you. Yes, you take the fair value of the option at the grant date if it's there for services, which it will be. But we're not normally going to see anything to do with goods, although we did cover an example in the notes. It says there that we have 400 employees. That was on the 1st of January X3. And here, ever so slight change, 4 years. I think all the examples we've done so far have been 3 years, but here it's 4. The fair value of each option at the grant date was $5, but we need to then think about the number of employees and the expected number of employees that there will be at the end of 4 years. So at the end of our first year, it says 25 left. So 25 left in the year to December 20x3. So they've gone. They're never going to go through and receive the options at the end of the vesting period. So we'll need to remove those from our estimate. But that's X3. That's what's happened in the past. What about in X4, X5, X6? How many employees do we expect to have left there? Well, it says there that we expect a further 60 to leave in the future, as well as the 25 that have left in the past. So we need to adjust for those 60 that we expect to leave in the future, don't we? And we make that adjustment today at the 31st of December. Okay, so what have we got? Let's go through, piece it together, put in all the numbers. So what you've got there, was it, I think, 1,000 options. We started off with 400 employees. Of the 400, 25 have left, and we expect a further 60 to leave into the future, don't we? Okay. The fair value at the grant date of the equity settled share-based payment scheme was 5. Do just be very careful, because here it is a 4-year vesting scheme, isn't it? And we're at the end of, is it the first year? Tap that onto your calculator, you get, is it 393,750, isn't it? Okay, 393,750. It's then when you say a little prayer to yourself and hope that that number's there, which it is. So that 393750 you would drag and drop, because this is a drag and drop question. You can't really see that from the way that we've set it up within the notes, but that's what it would do. Okay. Then you need to put in the account references. So here you are debiting your profit or loss, aren't we? Because we recognise an expense. And then the credit entry, be careful. It's equity settled, isn't it? And with equity settled, we will credit our other components of equity. Okay. We don't credit your non-current liabilities. We would do if it was cash settled. And we don't credit share capital because the shares haven't yet been issued. When we do issue the shares in the future, we can save that for a later date if you so wish. But that's when you begin to credit share capital, credit share premium, and remove that other component of equity. But that's just going one step too far. So what do you think about that question? Thumbs up. I think that's pretty standard. Obviously, there are little tricks. I think the difficult bit is the estimation of the number of employees. So don't forget, we need to adjust for who has left and who we expect to leave. Okay, if you can deal with that, if you can deal with the fair value and use the right fair value and spread it over the right period of time, then you shouldn't go too far wrong. So have a bash at the questions in the revision bank, see how you get on, and if you do get stuck, then we're here. See you in the next session.